Welcome to GRI Global Hospitality Committee's September session. I'm Lisa Engel, Managing Director of Barclay Capital Group and Chair of the committee. We are pleased to share with you our keynote presentation by George Nicholas, Global Head of Hotels at Savills, who discusses first half 2020 global hotel transaction activity and key takeaways.
With some notable deals, which have been going on for the last few months. These are deals which in most instances commenced prior to COVID, most of which started last year. And to be clear, this is merely a snapshot of some of the global deals available to show you, but we can see a mixed story of uncertainty and cautious optimism. In some way, these deals tell a story of confidence of a rebound, and in some way they identify the potential divergence in the shape of the recovery for certain sectors in the absence of a widely distributed vaccine. And as Ian Bremmer said in the last few days, he was talking about a K-shaped recovery, highlighting the differences between the haves and the have-nots. So we should ask ourselves whether this might be true for certain asset types in the lodging sector for the foreseeable non-vaccine future. Will smaller luxury, smaller economy hotels where hygiene is perceived to be more controllable win out over the big box hotels? Maybe. Listen, but as you'll see on the left, you'll see a hotel that we agreed a sale on in Austin, Texas last year with two public companies. It's the W Hotel, together with a sizable live music and event venue. The deal was agreed in 2019. It was meant to close in early 2020, but the news of the developing pandemic slowed the completion and ultimately the lockdown and more clear financial implications of the buyer's own company's financial position forced the buyer to withdraw and forfeit their $15 million hard money deposit. Perhaps this is an example of the down leg of the K-shape. Fortunately, there was no acrimony between the buyer and the seller, and perhaps the two parties can pick up discussions again when there's more clarity on the future of trading. But this is, however, in somewhat of a contrast to the next hotel in Venice, which we sold for Elliott and Blue Sky, where we also agreed a sale of an underperforming privately owned hotel to an off-market Austrian billionaire-backed real estate firm. There was little emphasis placed on the 2020 to 2024 income levels anyway, due to a planned renovation and repositioning, and the shape of his investment profile barely changed. So that deal was agreed in December, before we knew anything about COVID, and it was meant to complete in January, February, but the pandemic in northern Italy and in Venice halted the necessary paperwork from being stamped, and we scheduled completion of the deal to June after lockdown was lifted, and this is an example of perhaps the top leg of the K. Also, you'll see in the last few days, the French investor Covivio completed a close to 600 million euro transaction of the 1,100 room portfolio from Vade as seller. It was a lease deal, and it's an example of another deal which was agreed pre-COVID, but they ultimately went ahead anyway. On the next slide, you'll see hotels, which obviously most of us know about. The deal, the strategic hotels portfolio, and the deal was wobbly going into COVID, but COVID provided an excuse and an impetus for the buyer to revisit the deal. Now, that's not all that was going on, and there is litigation in the Delaware courts relating to the inconsistencies in relation to the way that the title of some of those assets was represented. And the longer this goes on, the less likely it is that the transaction will actually ever happen or be forced to happen. And then turning the spotlight, to Japan, where a Japanese hotel company, Uniso, was engaged with several US private equity firms late last year as they were identified to be under pressure to restructure. The appearance of distress attracted several bidders that what turned out to be a reasonably competitive dialogue, which culminated in the deal being awarded to Lone Star in April. and we're watching that carefully now to see how that one unfolds. And lastly, a deal which didn't happen, a deal that's not on the books, a deal which will show, why transaction activity is slowing. And it's a deal that was paused and then ultimately withdrawn, and where we were involved in an Australian portfolio recapitalisation, where terms were agreed actually in January, but COVID developments and global shutdown highlighted concerns over early trading, and terms were revisited again in February. But ultimately, it was decided that by both parties just needed to take a step back and see where things were going. So quickly back to the lodging equities market, the listed REIT and hotels companies. I won't dive into those because there's fantastic public research available on all those markets, but I will tell you quite simply that the material decline in share and unit prices, as well as disruption to the cash positions of those public entities, coupled with the nature of their securitized debt, has had an adverse impact on the market for obvious reasons. In the most obvious way, has provided a distraction and an immediate access to acquire perceived value in the significant discount positions from what were the February agreed values. Investors, would ask us quite simply and fairly, why would I buy a hotel asset at a 5 to 15% discount where I can buy, for example, Host or Park hotels at a 50% discount? Now, unlike public securities, investment in direct hotel real estate in physical bricks as opposed to paper takes longer to analyse and value, and the changes in values move slower and take longer to process and register. And it's because of this that last time during the GFC that we found some portfolio managers across a broad spectrum of asset classes wanting to liquidate their hotel real estate because they found themselves overweight in the hotel real estate asset class compared to other investments which had taken a little more of an immediate correction. So other equities, obviously this wouldn't apply in this instance to if you're invested in tech. And that brings me to the next slide. And I've called it the story of hotel real estate, subheading the grieving cycle, which I first saw by, suggested and presented by Ethan Penner, who was one of the chief architects of the world's CMBS in 2009. But it holds as true today as it did back then. And I'll explain why I think there'll be a period of lower transaction volume. Now, if you look at the chart, you have the x-axis along the bottom. And I'll start out with what Ethan and others identified as the beginning of the peak of the hotel market value. And let's say the time before it was broadly known that the pandemic was in full swing and that the world tourism market was coming to a grinding halt. And the y-axis is hotel real estate values, which I'd broadly put down as cap rates. And of course, I could have used average price per key, but here I'll use cap rates. And let's say that in February, we're looking at hotel cap rates across the market on average at 4%. Again, this is just a very crude story that I'm telling, and of course doesn't account for the cap rates was being applied to pro forma income and pro forma NOIs, which were sometimes quite optimistic, and projections on which were using strong growth rates. Now here I'm forecasting that a year later, so in February 21, that things aren't going so well, that we've survived a northern winter, but travel is still slow and there's no vaccine in production yet. And I think if you were to look at the recent sales of some of the, recent sales and analyze some of the indices, and the properties which were being valued, in February 2020 are now being valued and selling at a 5 cap, and values have, ostensibly declined by 15 to 20%. And we look this time, 18 months or a year later, where for example, all of you on this webinar and leaders of the industry might say that values have declined a little further, and we still have room to go because it doesn't feel so good, and most people feel like the market is slow and tourism isn't coming back as quick, and there's no reason to be optimistic. And we're probably going to bottom out at maybe a 7, right? So the things are moving down. And I call this the line of denial, okay? And for everyone on this call who were here during the GFC, you know what I'm talking about. Now, I call this the line of denial because having been in the market for a while, I know that markets don't go down slow, they go up slow. And they go down very fast. So we can see from the REIT, the REIT pricing, that something like this happened, and we can just see that the bottom has fallen out of the market. And while all the liquidity and confidence in the market that got values to where they were fell out of bed, it fell out of bed overnight. And and the bid for hotel real estate is probably on average now a 7 cap, and we saw that in the in the REIT markets. Again, this is just a crude highlight of value. And all of us would like to pretend that this is just a little temporary health crisis and that it'll come back soon. We'd like to believe that the market has paused and there is no bid. But the truth is that at any time since February and now going forward for the next 2 years, if we wanted to solicit a bid from a buyer, I'm not going to have a problem in getting a bid. There's a lot of money in the system, more than there was before. It's looking for a home. It's just not underwriting a 4 cap anymore. And the bid will be pretty much consistent over the course of the next 18 months to 2 years. However long it takes for them to come up and widely distribute a vaccine for us to be able to see, material upward movement in RevPAR. But we will suffer through, which we always have. And when a market like this dislocates and affects liquidity, we'll suffer through a period where owners of hotels want to believe that this is a temporary change and they want to hold on and they need to hold on, and the people who still have dry powder are holding on to it very dearly, but they believe that we're in a whole new era. And depending on the segment and what we're seeing around the world, we're perhaps in a new world tourism order where, and a new reality, and as such, new price levels in this, in different segments. And so we'll have this protracted period of low transaction volume. And for businesses like some of yours that rely on transaction to stimulate growth and you doing business, it's not great. But it'll potentially provide opportunities too, which may not have otherwise arisen. And we've seen this before in the beginning of the GFC where, roughly from the beginning of 2008 to roughly the end of 2009. And then all of a sudden things started to happen. NAMA was formed, the US private equity firms came to town, NPLs were selling and stimulating sales, and we're off to the races, and things started to sell again at a whole new level. You can see from this chart that this is precisely what happened in the period immediately following the collapse of Lehman. At the start of the GFC, where liquidity dried up, but in the years following, that the same properties were sold and resold at higher levels based on the lowering cost of debt once it became more readily available. So we need to ask ourselves, will the lowering value of the bond market turn ultimately into the lowering of the cost of borrowing? Will that drive values even higher? Well, if the denominator was lower and the numerator stayed the same, then yes, that might happen. But we don't yet know what the extent of the global travel patterns, will be and whether they're going to resume to those same levels. So that provides a little bit of uncertainty. You can see that due to some of the deals which were withdrawn and due to the lower pricing here in 2020, where the market is now down 42% year on year. And if we break that down into months, you can see that we got off to a great start at the beginning of the year, which was slightly up in January and February. But in March, when it became apparent that things might be drawn out, then deals were put on ice and just quite simply haven't returned. And you can see here, here we go, in the chart titled Single Asset versus Portfolio Transactions, that fewer bigger portfolio deals have been consummated in favour of single asset deals where underwriting is perhaps slightly easier to do and debt is more readily available. So we ask ourselves now, and I get asked all the time, when do you think things will, on average, performance and values get back to the same levels as they were earlier this year? So, what we did is we analysed the 9/11 performance recovery and overlaid the recovery of value and transaction activity. And you can see that the STR numbers, it took, this was just in the USA, by the way, that the market average RevPAR took 45 weeks or slightly over 3.5 years to reach the same level as it was prior to the events on that day, almost 19 years ago. It took 31 months for the whole market to reach the same level of confidence that the recovery was underway, and it took only 2 years for the values based on an average price per room to reach the same level that they were before the event, which ultimately shocked the world and put the travel system into a spin. Now, we then looked at the event-driven GFC, which took slightly longer for the RevPAR to return to the previous levels, perhaps in correlation to the significant build-up of lodging supply in the US. Again, this is just in the US. Prior to the years of 2008, but RevPAR returned after 4.5 years, and transaction volume, you can see, took 2.5 years to come back, but average values, on an average value per key basis, came back only after 24 months, 2 years. The notable point here is a point at 17 months, and you'll see, just here where there was an uptick in RevPAR, and that drove confidence in forecasting and therefore in pricing. Now, when we look and we analyse the same for Europe, we can see that the same patterns occurred with slightly different numbers. So you're no doubt aware that the European market isn't as homogenous as the US market, and we're dealing with the ensuing sovereign crises in Greece and Italy. So that slowed things down. As such, it took RevPAR just over 6.5 years rather, to recover, and over 5 years or 5.5 years for transactions to recover, the transaction activity level to recover to the same level as it was prior to going into the GFC. But here's the really interesting part. It only took 3 years for the average price per key to bounce back to the pre-GFC levels. Now, if we look at this inflection point after 18 months, it took 18 months for the price per key, or 19 months for the price per key to recover after we saw an uptick in RevPAR. Whereas in the US, go back to the slide before, the same matrix, it only took 7 months from the uptick in RevPAR to the recovery of the average price per key. Obviously, it's a different scenario, it's a different situation. COVID isn't over and we don't have a vaccine, borders are still closed, but interestingly, RevPAR is already increasing from its lows. I'll put it to you, I'll invite you to think about it. Is the clock ticking? Are we somewhere between now 7 to 19 months away from a recovery in average price per key? Listen, I wouldn't be betting against the industry from here, but I would certainly be proceeding and I'd be moving ahead as quickly as I can, with a lot of caution.